flow. They have a management team, a PE ratio, a balance sheet, and various types of risks associated with the fact that they are investments. After all, they call it risk versus reward. But on the other hand, gold should be compared to national currencies because gold is money. It doesn't increase your wealth. An ounce of gold still buys the same amount of crude oil it did 60 years ago. Who wants an investment like that? But you do want money like that because it preserves purchasing power over long periods of time, which is one of the key functions, of course, of money. So, given the fact that you want to compare gold to national currency, let's look at this table. This is a comparison of gold to national currency. This is gold's performance over the last 11 years against 9 of the world's major currencies. US dollar, Australian, Canadian dollar, Chinese yuan, euro, Indian rupee, Japanese yen, Swiss franc, and the British pound. You can see very little red on that chart. Basically, gold is going up against all of the world's major currencies. So, if you go back to the point I was making about the portfolio, gold or national currencies, clearly you want to own gold. And just look at the Canadian dollar, 13.7% per annum on average for each of the last 11 years, against the US dollar, 17.7% per annum on average in each of the last 11 years. And the US dollar, gold in US dollar terms, has been up 11 years in a row. Now, are you earning 13.7% per annum on your Canadian dollar bank deposit? Or are you earning 17.7% per annum interest on your US dollar bank deposit? And keep in mind too, when you own physical gold, you own a tangible asset. You don't have counterparty risk when you own a tangible asset. You don't have to worry about your bank going under when you own physical gold. You do have to worry about the counterparty risk when you own national currency, because those national currencies have to be deposited somewhere. You also have to worry about inflation risks and all the other risks that come with national currency that you don't have when you own physical metal. Now this is the gold chart, and before I switch to the next table, I just want to make one point. If you look at 2008, gold that year was down 14% against the Japanese yen and up 43% against the British pound. And if you look at that 1 year in isolation, you might say, oh, gold really is volatile. But if you look at the very bottom, the 11-year average, per annum average, 13.9% for the yen, 17.7% for the British pound, really not much different. Gold is something that cannot be looked at from month to month or even from year to year. You have to look at it over multi-years to determine what's really happening. Because in this currency system that we have today, where currencies float up and down relative to each other, depending on what a central bank in one country is doing versus a central bank in another country, all of these currencies are sinking relative to gold, which is what the chart is showing. And not only are they sinking relative to gold, they're also sinking relative to silver. So this is the same 9 currencies, the same 11 years, the annual rates of appreciation for silver against those currencies. Now the interesting thing is that the rates of appreciation for silver are greater. In other words, those 11-year averages at the bottom are higher than they are for gold. But just by looking at this table, you can also notice there's a lot of red on this table compared to what was on gold. So silver is also a form of money, but it's also an industrial commodity. Because you have these 2 different types of demand for silver, you get a lot of volatility that you don't get with gold. And this volatility, of course, is measured by the gold-silver ratio. How many ounces of silver is equal to 1 ounce of gold? The historical average is about 16 to 1. Back in January 1980, at the peak of the last bull market, we were about 17 or 17 and a half ounces of silver to 1 ounce of gold. Then during the bear market through the 1980s and the early 1990s, we got up to 105 ounces of silver to 1 ounce of gold. Last year in April, when silver approached $50 again, the ratio was about 31 ounces. Then after the correction, we got up to about 57 or 58 ounces of silver to 1 ounce of gold. So you can see this volatility. And we're now moving back down toward 50 ounces of silver per 1 ounce of gold. And my expectation is before the end of this year, we're probably going to be back down to 30 ounces of silver per 1 ounce of gold. So if you've heard me speak or if you read some of my stuff on the internet, you know that I'm more bullish on silver on the long term than I am on gold. Because the supply-demand fundamentals of silver are that much more exciting to me than gold supply-demand characteristics. So as bullish as I am on gold, I'm more bullish on silver. But silver has a lot of volatility, and that means silver is not for everyone. So when you're looking at your precious metal portfolio, if you're prepared to put some silver into it, my normal recommendation is to have 2/3 of your metal in physical gold and 1/3 of your metal in physical silver. And if silver outperforms, as the bull market moves forward, as I expect, when it's all said and done, you're going to have a higher valuation of silver in your portfolio than you will in gold. Now, just like I measured crude oil prices in terms of gold, stock indices can also be measured in terms of gold. In other words, I'm making a case that don't only just measure tangible assets in terms of gold, also measure financial assets in terms of gold. You can see a clear boom-bust cycle here that is a consequence of the banking system, where they land and land and land, borrow, borrow, until you get the illusions of prosperity and the boom. But inevitably, a lot of bad investments are made, balance sheets get over-leveraged, reality comes home, and you get the bust. So you get the boom in the 20s, the bust in the 30s, the boom in the 50s and the 60s, the bust in the 70s, the boom in the 80s and 90s, and the bust that we've been going through. Now, I use this chart, as some of you may know, to project the price of gold back in 2003, when gold was trading about $350 an ounce. I was interviewing Barron's, which is the U.S. financial newspaper, and I used this chart to explain that gold, by 2013 to 2015, when this financial bust I suggested would be over, would be $8,000 an ounce. And basically what I was saying, you're going to see a one-to-one relationship between the Dow and gold. This is an intraday chart, a monthly chart, so it doesn't have intraday prices. But back in the 30s, the Dow Jones Industrials, believe it or not, was 35, gold was 35 at the end of that bust. In 1980, as some of the older people in this room could remember like I do, gold was 800 and the Dow Jones Industrial was 800. So I was telling Barron's, at some point in time in the future, we're going to see one-to-one, and I suggested 8,000 on the Dow and 8,000 on gold. And the reason why I said that is that we all know that gold went from $35 to $800 in the 1970s. That's a fact. And in 2003, it took about $10 to purchase what $1 purchased in 1971 because of inflation over the intervening 32-year period of time. So what I was saying to Barron's is that on an inflation-adjusted basis, history is going to repeat. Just like we went from 35 to 800, allowing for the inflation over 32 years, we were going to go from 350 to 8,000. I'm still of that view, but as you see in a moment, I actually think I'm too conservative. We're going to see a higher price. But let me just go through this chart. I just want to make one other point. That's the FTSE, which is the London average. This boom-bust cycle is global. And that's the DAX, which is the German index. I don't have the historical data, but it basically shows that this boom-bust cycle is something that we have to live with. And basically what it's saying, in terms of the major indices, stocks or cash. In 2000, we wanted to be out of the Dow, we wanted to be out of the FTSE and sitting in cash. But as those tables show, in terms of gold appreciation, you don't want to be sitting in pound cash or dollar cash, you want to be sitting in gold cash. And you want to keep sitting in gold cash until we get to that one-to-one ratio, the cycle's over. Then you take your gold and invest in the next boom-bust cycle. So what we need here in the 21st century is a safe place to put our currency, not banks because of the boom and bust cycle caused by fractional reserve banking, and no clearing, settlement, costs, payment risk, or political risk. And I want to emphasize this point because I believe the U.S. dollar is headed for hyperinflation, and that has real implications to everyone up here in Canada if the U.S. dollar does hyperinflate. Let me explain this point. This is U.S. government federal tax receipts. This is expenditures. This is a 12-month moving average of what the U.S. Federal government is spending. We use the 12-month moving average to smooth the month-to-month fluctuations. And this is what the U.S. government is receiving. So you've got this huge gap between what they're spending and what they're receiving. And you can see from this chart that this is not a cyclical problem. This is a structural problem that they've been dealing with for years. Now, the Federal Reserve is trying to pump up the economy to boost federal revenues. And there has been some increase in federal revenues, but they're spending money as fast as it's coming in, and this deficit is not being attacked. And it's this deficit that causes hyperinflation. If you look at monetary history where the currency is hyperinflated, regardless of which country you're talking about, it's government spending where the central bank turns that government debt into currency and causes hyperinflation because there's no discipline on the government. It manifests itself as a paper currency hyperinflation in places like Zimbabwe or Weimar, Germany, because very few people have bank accounts and most commerce was conducted by paper. It manifests itself as a deposit currency hyperinflation in places like Argentina in 1991,